Mr. Christian Wehbe. Welcome.
Thank you. Thank you very much for this introduction. Actually, I think you phrased it very well. In the business, we like to say gold is the metal everyone loves to hate. And I'll say from the beginning, actually, I'm not what you consider a gold bug, but very much a gold enthusiast. My background initially was actually in hedge funds until a few years back I started focusing on gold for various reasons. And it was with that in mind that I joined EFG last year to help them in developing various gold products and also our new range of Quantoxao products. Maybe to give some background, the background on this presentation is actually a little bit entertaining because when EFG asked me would I like to come up and speak about gold, I was obviously very excited to be on the same podium as Dr. Wilmot, Dr. Ising, and Dr. Rubini. So I got home and I told my girlfriend, I was like, oh, you know, I've got this great event coming up. I'm really excited. I'll be able to talk about gold, etc. And we were both really happy. So I said, well, why don't I, I'm familiar with Dr. Rubini's Dr. Doom kind of philosophies, with which I have to agree quite a bit. Obviously, his legacy from the subprime prediction. But for some reason, I had no idea what he thought about gold. And so I go on Google and I just type, Rubini and gold. And I see what comes up. And obviously, I knew what Jim Rogers thought about it, and I know what Mark Faber thought about it, and that was all very enthusiastic. And I start going pale. And my girlfriend asked me, what's wrong, Christian? And I said, I just feel like someone asked me, do I want to meet Mike Tyson, when they actually meant you want to spar with Mike Tyson. Actually, Dr. Rubini is extremely bearish on gold. He thinks it's a huge bubble. So I thought I might as well just embrace it, because in case it comes out in the presentation afterwards, not to be completely discredited, at least I can address it in a few slides. So it's a typical topic that comes up a lot. Just to give you a very quick breakdown of what I would like to address, very briefly, what's the definition of a bubble? Tulip Mania, Wall Street 2 came out, and so since then everyone's talking about Tulip Mania, but I just want to go in a bit of details of that. And then a theme that I find very interesting is America. And since people are always focusing, on gold, is gold a bubble? Look at maybe some of the fundamental numbers of America and then draw some conclusions there to end off on our Quantoxao products if we have some time. What I chose to do here, and I'm not going to go through point to point because it's extremely dry and boring, but I just wanted to briefly aboard what Minsky's 7 steps of a bubble were. Minsky was an economist in the middle of the 20th century, and unfortunately his thesis only became famous after the subprime bubble. And basically what he's saying is the human being is naturally greedy. So as long as you have an economy that is doing well, the greed will drive any economy into a bubble. And now looking back, it does seem it happened that way. It's basically in 7 stages. They're all kind of overlapping, and depending what you read, there's 6 stages or 8 stages. So I'm just kind of going to explain it very, summarized. What you need is, first of all, a displacement. And what he means by displacement is a paradigm shift, which are basically 2 things. A, an innovation, like how the IT bubble happened, or B, low interest rates. Which means that the opportunity cost to gamble onto a certain idea, the markets, et cetera, are very small. The interest rate theory comes off a lot in many of his points. Then he said the next stage is expansion, so that's when the first players come in. The fundamentals look good, prices come up slowly. Then we happen very quickly in the stage of euphoria. So you got the outsiders starting to come in, et cetera, as well. And then we come to the overtrading, and this is when the professionals start exiting, and you start hearing stories about, okay, bubble is starting to develop a bit like 2006 or even 2005 in the US, in the housing bubble, or even in the UK at that time. Everyone kind of ignores it because we're just all busy trading. Then happens the market reversal. The professionals are already out. Here you just have the insiders still in, and as what he called is when the desperate, it's not my words, but he said when the desperate and the greedy come into the market. And then you have the theory of greater fool. So they just pass on whatever it is to the rest. Financial crisis happens, the first panics arise, the last insiders exit, and then revulsion, where the house is burning, everybody knows what's happening, and there's panic in the market. Now, personally, especially when I started learning about gold, I always like to put things in context of history because although we think that we're all very, very intelligent, we seem to make the same mistakes again and again and again. So I thought, why don't we look at the biggest bubble and really how that happened? Tulip Mania was actually quite an entertaining story how it happened. It developed from a researcher who went to the Ottoman Empire and wanted to do medical research, who brought some bulbs back. And it was his neighbors that found the flowers very beautiful and wanted to buy it from him. He didn't want to sell it because he wanted to do his research, so they stole the bulbs. And then a few years later, the market of tulips developed. What was important with the tulips was it was not really a requirement in any kind. It was just a fashionable statement and a luxury. It was extremely rare because it took 7 years for the tulip to grow, and the mother bulb would die fairly quickly afterwards. So it was the rarity that made the bulb very, very expensive. The way it was traded also, because you could only take out the tulips between June and September, you had to trade it throughout the year, so that's when actually the first futures market developed. So they would do it as papers, and funny enough, 500, 600 years later, it didn't really change a lot. Basically, they met in bars and traded the papers, and there was no real margin. All you had to do is pay a wine tax. So if you had enough money to get everyone drunk, you were a trader in those days. Then came the speculation. So what was really rare were the tulips that were double-colored like you saw before because they had this special virus. And it got to an excess where around 1630s, this is amongst the most expensive bulb that was sold. At this time, you have to keep in mind, they didn't even grow out the tulips. The bulbs were just sold as they were. And there was a very sad story about a sailor that thought once it was an onion, and he made a very expensive omelet out of it. It was exchanged, and I'm not going to go through the list, but this is what one bulb was worth. As you can see, I mean, I was impressed by the 3,800 liters. I have no idea how in the 17th century you transport 3,800 liters. But this is basically what a bulb was worth. And here we were at the peak of the bubble. Again, what is important here is you were selling a luxury good that people wanted out of appearance. There was no entry costs because all you had to do is pay the tavern. And the rest just took a huge size where paper was trading 10 times a day. And then it all burst with one single event. And it was really the typical sign of the emperor had no clothes. There was just one guy that didn't turn up to pay for a bulb, and the whole thing collapsed. So that's really the trigger effect. And within a few days, prices lost, went to 100th of what they were before. So for me, that's really the ultimate bubble. And I think these bubbles we will continue to see in goods that we do not really need and are simple luxuries because people get carried away. Okay. Did I go one slide too far? Okay, so, we're jumping right into the USA. Perfect. There was an analysis that from KBCP that drew a lot of attention. There's a lot of criticism, both sides. Is it realistic or what they tried to do is basically establish the US. If it were a company, what would it look like? What would its balance sheet look like? It is tricky because you cannot, there's some factors you cannot take into account. It's very difficult to value the resources of all the commodities in the US, the power to tax, the power to mint, those things. So they took that aside. But what they did is they said, okay, first of all, let's look at the negative cash, at the cash flow. The US has had a 9-year negative cash flow. From those 4.8 trillion, about 50% of it come from 2009 and 2010. This analysis was done in 2011. So you have a clear acceleration. Then they have a negative net worth. The hypothesis of this is Social Security and Medicare. Now, this is not a direct criticism on the US because every government does this. Usually, if you have a company, you have to value all your liabilities, if you know what your liabilities are going to be in the future. Now, what governments do, they don't discount to today what those debts are going to be going forward. So what KBCP did is they valued what Medicare is going to cost over 75 years, and they came up to 31 trillion, which is why the negative net worth is so low of America. Obviously, the debt situation, we are all aware. They expect that in 10 to 15 years, that will reach 90%, and in 20 years, it will be 150% of GDP. And then that they have an unbalanced spending. basically means that by 2025, all the revenue that they will gain from income tax are just going to pay for Medicare and Social Security plus interest. You haven't paid for schools, you haven't paid for infrastructure, you haven't paid for military. Negative financials. Negative cash flow per share, that's fine, that's pretty straightforward. Net debt to EBITDA, that is at -8 times. Now this I had to actually go see an accountant because I had no idea what that meant. Because usually debt to EBITDA tells you how long it will take you, how many years it will take you to pay back your debt. The accountant had no idea what that meant. And then I researched a little bit, and it comes out only venture capitalists use this if it's negative. And venture capitalists say it's not necessarily a bad sign, but you cannot really measure it in years. It simply means that if you are a startup company, you're going to have negative cash flow in the first years, and that you'll be investing into more growth infrastructure going forward, and you'll recapture that. Now, I think it will be saying a bit of a stretch calling the US a startup. So I think this is a pretty negative interpretation. It's not like they're investing their cash in something, they're going to get something back. They're just really paying off their debt. Okay, and obviously negative net margins of 60%. Conclusion was the USA needed a turnaround manager, but nevertheless remains our main currency worldwide. Oh, this is, before I get to that slide, we've seen a lot in Hollywood movies about gangsters, you know, robbing banks with millions of dollars, and they come out with all these bags and trucks, etc. Since we're starting to throw around millions, billions, and trillions so quickly, I thought it would be worth to just kind of try and visualize what that is. Now, $1 million is about like that, if it's in $100 bills, packed up in little packs. $1 billion is that. So it doesn't take up too much size. Now, psychologically, for many people, including myself, $1 trillion doesn't really sound that much bigger. That's $1 trillion. And that's double-decked. So this is just one stack. There, it's double-decked. It's about 1.5 football fields. That's $1 trillion. Obviously, we all know where the debt situation of the US is at -16 trillion. I don't even know if Germany could have printed that much money in the 20s. I have no idea how long that would take. But that is what has artificially been created. Okay. Open market operations and how it works. The reason why I want to address this, and it may sound dry in the beginning, but it is quite important to understand, is people use quantitative easing and and open market operations simultaneously. They're two different things. One thing is open market operations is what the Fed or central banks use to manage interest rates. So just as a reminder to everyone, how it works is the government comes out, well, the Federal Reserve comes out and says, okay, we have to decrease interest rates to X amount. This is our target rate. And what we're going to do is we're going to buy short-term debt from banks in the market. So what happens? The bank, well, I can't really name any banks. So there's a commercial bank that will sell this T-bill to the Fed. And what the Fed will do is they will credit his account with $100, for instance. Now, these $100, the bank is free to do whatever it wants, and it's in its reserves, reserves with the Fed. So typically what happens is the bank keeps its reserves, which in the US is typically around 10%, and lends the rest to the market. Now what that means, lends to the market, it lends to other banks so they can keep their reserves, because some are underfunded, some are overfunded, right? So it's just banks lending to each other so they don't default on their reserves. That's really what happens. And then what the Fed rate is an average of all those individual rates. And that's how it happens. So that's how they decrease it. Now, there comes a situation, obviously, when interest rates are extremely low, the Fed can't do anything. That's when we come to quantitative easing. Now, in anything you read on quantitative easing, it always comes up as a last resort. Unfortunately, the press hasn't shown it this way because it just sounds like a really fancy way how we can jumpstart an economy. How quantitative easing works is they do not focus on a target interest rate because it's already low, but they target a certain quantity of money. Use it the same way. They buy longer-term bonds, so they push down the yield curve at the end of the curve, basically, and credit the amount to the banks for them to inject into the market via lending to each other. QE1 and QE2 over 2008, 2009 amounted up to about 2 trillion. Okay? We all hear about there's no inflation, where has all this money gone? And the economy is not really bouncing back. The interesting thing is, instead of re-injecting the cash, the banks have increased their reserves with the Fed. Now, the reasons why they have done that is because A, they got criticized for giving out risky loans. B, they're getting a guaranteed 25 basis points from the Fed. And C, why take on risk if you're getting paid for money that you don't even really, you got for free? So basically how it works is you get the money, you give it back to the Fed, and you get 25 basis points. It's a great deal for the banks. The problem is, that's what happened to the reserves. And that's why you do not see any inflation in the market, because it's all here. This goes back to 2000. This is where the reserves typically are. This is how they spiked up since 2008. The interesting part is we remember it's about 2 trillion that was injected. Here we are around, I guess, 0.1 trillion, and now they have about 1.7. So about 1.5 trillion increased in the reserves. That is difficult to believe that that's just a coincidence of that period. Okay. US Treasury market. This is a topic I always enjoy talking about because whenever we speak with people or the press, and I'm quite amazed because sometimes the press really comes out with this and says, China is the biggest holder of US debt. That is wrong. The biggest holder of US debt is the Federal Reserve. Okay? So if we're here, this is up to September 2011. We have 14.7 trillion. The Federal Reserve holds about 36% of all the debt issued of America. So the thing is, you have a complete concentration. Now, just a few notes on the debt ceiling, because that got a lot of attention last year, and nobody, including myself, understood anything about it, because it was really complex, and there was just different committees, and no one came to a decision. What happened was basically we reached the debt ceiling, which was 14.1 trillion, and they came together and said, we have to raise this, the ceiling again. Just to put things in perspective, under Reagan, the debt ceiling was at 1 trillion. Under Bush, when he started, was at 7 trillion. We're above 15 today. So you see the clear acceleration of the debt ceiling that just keeps on getting increased again and again. So what happened was, obviously they had to raise the ceiling because, I mean, there was no other options. So the committee came out and said, okay, we'll raise the ceiling if you can show us that you can cut costs over a 10-year period. So Obama came out and he said, okay, well, we need, initial 0.4 trillion, then a 0.5 trillion, and then a reserve of 1.2 trillion if things really go bad. And they said, okay, well, show us how you're going to cut costs for 0.9 trillion. So they did this theory, and they said, over 10 years, this is how we're going to cut our costs. Most of the costs are only going to get cut 10 years down the line. This was end of last year. By January, the 0.4, he already requested. The 0.5, he requested. So now he had to reissue a request at 1.2. They put together a super committee in November that had to come up with a theory to how to cut costs. They didn't manage to do that. And now what they're going to do, in order to implement this 1.2, they're going to slash costs across the line. Now keep in mind, 1.2 is only 10%. That would be decreasing spending 10% over 10 years, and they didn't manage to do that. 1.2 trillion at the same time is what we've increased easily between 2009 and 2010, and 2010 and 2011. So, which means by the beginning of next year, we will have the same situation with the debt ceiling, except we'll have more debt and less options. Here's the situation of the Treasury market. Here you say clear accrual of treasuries from the Fed. There was a stagnation in September 2008, and then it accelerated towards the end, which kind of fills in with the rest. Okay. The foreign treasury market. It is true that China is the largest foreign holder, but in comparison to the Fed, who holds over 4 trillion, they only have 1.1. China and Japan together hold about 50% of all the treasuries. So what I'm trying to point out with this is when you look at these numbers, you just have to look at the top players, and it already gives you a very clear indication of where we're going. The interesting part, though, is here what the New York Times came out with, that as of 2009, they have been decreasing, China's been decreasing its purchases of T-bills. Now, as you'll see later, as I'll show you, simultaneously in 2008, 2009, China has increased its gold reserves by 70%, and have been amongst the most aggressive buyers with Russia over the past year. Okay, now we come to gold. So, what I want to show there is, yes, it could be that gold is in a bubble, but I think the situation in the US is also worth having a look at. The important thing about gold is people shouldn't forget why we use it today. The biggest chunk of the market is jewelry, but gold, as many people criticize, has no balance sheet, has no intrinsic value, it's very difficult to value. The most important thing of gold, it is rare. And that's why it was used in olden times, and that's how the first gold coins came. Actually, what happened was we started in a barter economy. We realized it wasn't very efficient for me to bring chickens in order to find clothes, right? Because I always had to find someone who needed the same thing in the middle. So what they thought was, why don't we use a commodity that is very rare and use that to change as an exchange tool? At the time it was jewelry, and then they realized, well, it's a little bit difficult that we should have a unanimous kind of good, and that's how the first gold coin came. Then reserve banking started, which means that you had golden deposits, and then you issued certificates of guarantees, and that's how modern banking started. Today, we have the same situation, except we're not backed by gold anymore. So that's really the role of gold. Here's the official government holdings worldwide. What is important here to see is coming out of the Second World War, America had the largest gold reserves, which is also one of the strong reasons why the dollar became the benchmark currency. They declined it here in the 60s and 70s. I'll address that afterwards. And after that, they kept it stagnated since then. The interesting thing with America is there's never been an external audit done on their gold. No one has any idea if that is even around. Germany, coming out of the Second World War, had no gold, but accumulated very quickly, and most Western worlds did. What happened here is most emerging markets didn't have so much gold, but here in 2009, you will see, I'm looking for China now here, okay, we went from 19.3 million ounces to 33.9. They increased aggressively, and Russia has been increasing here in white aggressively, especially in 2011 as well. So, these are the foreign reserves worldwide. Now, the interesting thing is to see that of the foreign reserves, as everyone knows, is basically the portfolio of a country and what they hold in it. The US still holds the most amount of gold by 8,000 tons. 8,000 tons represents 75% of their foreign reserves, which means they got very little euros, very little yen, very little anything else. Germany, same. 3,000 tons, 72% of their foreign reserves. If we look at the emerging markets, like China, for instance, after their increase, they're at 1,000 tons, so about an eighth of America, but it's only 1.7%. This shows why emerging markets are buying in so aggressively, because they hold a lot of dollars and a lot of euros. And they're looking to increase their gold reserves in comparison to their Western peers. In 2011, we've seen this across the line. Venezuela and Kazakhstan, well, Venezuela directly nationalized it, as Chavez likes to do. Kazakhstan didn't really nationalize it. They just said, we're going to buy all the production that is done in our country, so the government will buy its own production. And all these other countries have been increasing quite aggressively. There is a clear move of emerging market central banks increasing their gold reserves. A bit of background on the gold market, because we always focus on the investment side. It is important to note that jewelry is the largest section of the gold market. It's 44% of all gold ever mined, which is only 153,000 tons. That, to put in perspective, is about 1.5 pools of gold. That's it. That's all there is that has ever been mined since we exist. Official reserves is 21%, so that just means what governments hold. And this here, private stock, is all the bar hoarding, all the physical bars individuals hold. As you see, it is very small in comparison to jewelry, and the same as official reserves, which are governments. Production. These are the top 10 countries producing. What I found interesting again is with China. China actually for 5-6 years wasn't even in the top 10. Then they started increasing, so as we saw, they have a lot of margin to increase their gold reserves, but they're also the largest producer today. This is because in the mid-90s, they opened up the market for foreigners to exploit gold in their country, and in short, what they did, they acquired many foreign companies that deal in gold. Shows again their bullishness towards the commodity. As you can see, supply does not change really from year to year, no matter what the demand is. So that's really what it is. That's about approximately 2,500 tons. Okay, this is of the mining production today. As we saw here, we are in 2010 around 78 million ounces. Jewelry counts for 76 million of those ounces. So that means whatever you hear in investments and bar hoarding is coming either from scrap gold or for someone else that is holding bars, because the jewelry market is absorbing all of the new gold already. Important point is jewelry is also considered an investment in, for instance, India or China, because there it was completely controlled, so people were limited in how they were allowed to hold the metal. In India, for instance, something that was explained to me, which really surprised me, was culturally, when the husband died, the woman was only left with what she was wearing. So hence, they would wear a lot of gold. I know that since then it's developed a bit, but that was the reason why they had so much gold. This brings me to one of the most surprising points when I started studying the subject of gold. It's the physical versus paper market. Now, if there were a bubble, I would have to agree it would be in the paper market, but not in the physical market, because as you saw, physical gold is extremely rare. The paper market is what is traded on the futures market, what is in ETFs, even on the OTC market in London, which is supposed to be physical. Those are certificates that are being passed around, which reminds us a little bit about the Tulip example, where people are trading a lot of paper during the day on the same commodity. If we look at this, we summarize for 2010, the futures market and the LBMA OTC clearing volume was about 100 times that of the physical market, which is pretty high, even for commodities. Commodities typically trade with a 30 to 40 times leverage. Now, the unusual thing with gold, contrary to other commodities, is physical delivery can happen. People can request in larger quantities physical delivery. You wouldn't have this on pork bellies unless someone wants to have a huge barbecue. But in gold, it can happen that 1% of the people say, I would like to take delivery on my physical gold. Now, imagine what would happen if only 1% of the people holding these futures would request delivery. Here, I just broke it down a little bit to you in the ounces. What I'd like to add to this, in 2007, the CEO of the LBMA wrote a letter to the European Commission after figures came out on the trading volume. And the LBMA is basically the authority on the gold market. It's like the worldwide SEC on gold. And he wrote to the European Commission and said, actually, it's very difficult to calculate what the volume is due to the offsetting of trades. And he said a more realistic volume is about 5 to 9 times what they've indicated. So we don't even know how big the volume is in the paper market, in short. Maybe one point to add why that's important, because I think end of last year showed us a very good example of the two markets. Coming into September, I don't know if you recall, but gold prices were starting to come down as the fears in Europe increased. Now, what had happened there is there was a general panic in the market, and people were redeeming, for instance, from hedge funds. And as they're facing redemptions, typically hedge funds will come out of their winning positions. Now, if you're trading in the futures market and you have a 3 or 4% margin only and you start selling there, that will apply tremendous pressure on the price. Simultaneously, though, on the physical market, when I spoke with refiners, there hasn't been higher demand ever. Everyone was buying up on the physical market. So it was really strange because you had people being bearish in the paper market starting to sell, and the physical market was buying up as much as they could. For instance, if you speak with a refiner today that sells to UBS or Credit Suisse, to buy a certain quantity, and I was in this situation because we had a larger trade, you would have to wait about 3 to 4 weeks to get your bars. So the extension of waiting just shows again that there's a lot of demand for the physical metal, although that the paper is getting traded way too much. A bit of background, just a quick historical background on gold in the past and why it's important for us is, just to quickly explain again the Bretton Woods situation, because I remember when I went to university, our macro professor started explaining to us the FX markets and said, yeah, and when we came into the 70s, Nixon found it inefficient to have kind of like a natural peg towards gold and abolished it, and FX markets became the hugest markets in the world and more efficient. And we all concluded that was a great thing. That's not really what happened, actually. What had happened in that situation was, coming out of World War II, obviously the US became the peg, they had the largest gold reserves, but they had to respect a certain ratio. When we came into the end of the 60s, when Nixon got into power, the US had been at war in Vietnam for a while, and people were starting to doubt that he was backing his gold when he was printing the dollars. And amongst us was Charles de Gaulle in France, the first person who really confronted him on it. And then they said, okay, you know what, since we have no proof, well, it's going to be very simple. We're going to sell you the dollars, and you're going to give us the gold, basically. And so you had a run on the US, and that's why you saw how the gold reserves were decreasing so fast. What happened there is in 71, Nixon didn't want to respect the conversion anymore and abolished it completely. So it was actually an indirect default. It wasn't at all came out of nowhere. It was people because they were doubting that he was backing it. The second example of gold, how it can be important for a central bank, is again after World War II with Germany. World War I. Germany decided to finance its World War I without increasing its taxes. So what they did is they started taking their mark and not using the Reichsmark anymore and started to print money. At the end of the war, there was basically what you had the Traité de Versailles, where they said, okay, Germany, you provoked the war, so you're going to pay for some of the damages. And Germany said, that's no problem, we've got loads of marks. And then they said, no, you're going to pay us in a gold-backed currency or in Reichsmarks. So Germany then had to deplete all its gold reserves, and that's what happened, why there was such hyperinflation after that. The reason why I'm citing these two examples is, I'm not saying we'll ever come to this, but it's just for an intellectual perspective. If you were to value the US as the largest reserves today, what their gold would be worth, it's only worth about 430 billion. On the other hand, just their debt alone is around 15 trillion. So their gold only backs 2 to 3% of their debt. Gold confiscation. I just wanted to address this quickly because that's a question that comes up a lot, was a lot in the media, and maybe address what happened there. This was, again, a similar example where there was a rush on banks when FDR came to power in the midst of the Depression, and people doubted that he was backing his cash with gold. So they ran on the banks, and what he did is he said, okay, you know what, we're going to confiscate all gold. It was illegal to hold it. You could take up to 10 years imprisonment if you held it. And what they did is they opened all the vaults, and they said, we'll pay you 20 to 1. So they called it nationalization, not really confiscation. The only thing is, a couple of months later, they said, well, the real value of gold is not 20 to 1, it's 35 to 1. So they just took 40% of everyone's money, basically. Okay. All this being said, as you saw, I just wanted to address quickly that there is a possible bubble in the gold market. I don't deny that. People can get carried away. I personally think it has to do more with the paper market than the physical market, and I think that will catch up. That there's other markets like the US that are also worth looking at. And then if we're talking about bubbles, we should compare the likes. I just want to briefly touch on the back of all these thoughts, the ideas that we've had at EFG and what we wanted to do, because we think, well, having all these theories is good, but putting your money where your mouth is better. And that's when we came up with the concept. I know that Jan Schoch and his operations team were working on this for a while now, is to basically develop structured products that are denominated in what we call gold currency, XAU, which allows investors to not take direct currency exposure and treat gold really as a currency. It got a lot of press coverage. It was a little bit, it came out end of last year, a little bit tricky to catch on to in the beginning because it's a bit counterintuitive. So I thought I'll just address that quickly. Basically, how a product will work is you can have any underlying that you want. It has to have nothing with gold. You can have it on a reverse convertible on Euro stocks. The idea is following, though, is that when you invest on day one, you invest in XAU, which is like ounces. So you say, okay, I'll invest for 100 XAU. My product will pay me 15%, and in the end, I have 115 XAU. So this idea was really something where we said, okay, if people, right now we're in a situation where people have their doubt on the dollar, they have their doubts on the euro, unfortunately even on the Swiss franc as it's pegged to the euro. Let's try and find a common benchmark for everything. And it evolved in that. Maybe just very briefly how a product like that would look like. I don't want to go too much into detail, and I'm sure all of the EFG people here, including myself, would be happy to tell you more about it afterwards. A typical structure for which I found interesting was why don't we go do a structure on emerging markets? Because personally, I think those are the only markets that actually have cash today, because if we look in the Western world, they're all kind of struggling to get cash together for the future, and that's why they're taxing so high. Let's do a product where if we have the BRICS as underlying, we can offer a coupon of 6.1% every 6 months over a 3-year period if over any 6-month period the performance is positive. So, which means in short, basically, because I went a little bit backwards there. If over a 3-year period you think over 6 months your worst performing underlying has a positive performance, you can get out the coupon. It is also paid then in your ounces, and if you do not have a metals account, then you can convert it into any currency you'd like. So you can actually convert it in hindsight, basically. This product is a bit similar. It's just your typical reverse convertible, which we did on the miners because we had a lot of requests on miners. So we said, you know, it would be interesting to do a reverse convertible that is denominated in XAU as well. So yeah, so I don't want to go too much into the details of the product. That was pretty much my presentation. I'm more than happy to take any questions if anyone has any questions.
Now, any questions on gold? Here we go. Could you please pass the gentleman a microphone?
Could you go please back to your balance sheet of the US? Because I think your view is too static, because you talk about Medicare and things like that, but as we've seen in Greece, when you can't afford any aspirins anymore, you don't have any expenses. And that's one of the reasons why the pharmaceutical companies have gone down so much, because basically we can't afford Medicare anymore.
Yeah.
So what I'm saying is that I think this approach of this US balance sheet is too static, because you're assuming things about the future and we don't know if this is going to happen or not. Then there was this picture about the central banks, because if the emerging countries want to have more gold, they can just buy the gold from the Western world. So this won't affect the gold price. Would you agree to that?
Not really, because right now you're having, well, I'll start with the central banks, your last question. Right now you have, central banks were typically, historically, liquidity providers in the gold market. No one's really selling. Even the IMF is buying. So you can see, when you start seeing the transactions, you start seeing people are bar hoarding, basically. They're all trying to accumulate. And that's when all the conspiracy theories come out, like, when you're saying gold will reach 10,000, that was actually a hedge fund that came out with that theory, which I found really strange. But the theory behind it is, if the US wants to become a superpower again, it has the largest reserves, it will have, if gold reaches 10,000 an ounce, it will be able to pay back all its debt. So you have a lot of that thing going on. So you don't have governments selling to each other at the moment. There's very little liquidity in the market and a lot of demand. I mean, I'm telling you this because we speak a lot with the refiners, et cetera, and they confirm that. Now, on this balance sheet, I agree, it's extremely limited. It wasn't my balance sheet. That's why I gave a warning in the beginning that it got a lot of criticism. The Medicare situation in the US, it got passed, so it is a legal requirement, and that's why it's become a burden on the US. So it's the government that pays that, really. It's a huge debate. It's also a presidential debate at the moment for the upcoming elections, but I have to agree, it is very limited. I just want to give you a broad scheme of things maybe to think about.
Another question. Basically, you're suggesting that the US and the Western world is more or less bust, but if you make that assumption, then we will have a depression in the world, and then you need your gold just to buy food. So why would the gold price go up then?
Why would the gold price go up?
Yes, because basically we have seen in 2008, when there's a big panic and a fear of depression, the gold price goes down.
Okay.
So basically what I'm saying is that if you are now with this presentation saying that basically the Western world, the US is more or less bust, if a country is bust, basically we will have a depression worldwide. Yeah. And then of course the gold price will go down, because then everybody will need the gold just to go and buy food and a shirt.
Sure. The situation of the gold price going down in times of crisis, actually, the only time we saw that was the period between September and December, and it bounced back very quickly once it hit the 1520 levels, and it was financially dominated. Actually, gold held up very well between 2007 and today on the basis of that. The problem is, during short-term corrections with any asset class, correlation goes to 1. So when you have a crisis and a panic situation, everyone's selling in the market. And then you have a clearing up. That's why, for instance, in gold, as soon as it went down to 1520, we're trading to get today up at 1650. It's range bound again. It's got its solidity. When you're talking about a situation, I'm not saying that we're going to be, in a Mad Max scenario where we're at the end of the world. I just thought it would be worth looking at, some interesting extreme situations, because if we ever end up in that situation, gold is the least of your worries. You better start buying weapons, because people will just be robbing each other of its gold, etc. It gets really dark. And that's not what I'm saying. All I'm saying is, if this information starts, especially on the gold, which is factual information, starts trickling down in the press, then you'll create a panic effect. And when you create a panic effect like that, you'll have people starting to sell their ETFs, sell their futures, and start buying physical, and you'll have a huge shift. And that's when you'll go into a bubble. The panic will feed itself. That's more the point that I was trying to make. Not saying that we'll go there, but you can create panic very quickly.
Gentleman in the second row? Oh, after that, I'll ask you.
Your talk was mostly theoretical with a couple of product pitches at the end.
Mm-hmm.
My question to you is here, well, a little bit unfair. What is your view on gold? Where do you think it's going 1 year, 5 years, 10 years? And where do you think it is going to be in relation to the so-called reverse dollar hedge, or people holding both and US dollar correlation?
Sure. It's a good question, and it's a question I get often. I'll tell you what I tell most people is I typically do not like to give views on gold, because as you saw, it's completely concentrated. So if China decides to increase their percentage from 1.8 to 3%, that's pretty much the whole supply of a year, and that will move the market very aggressively. So there's very little triggers that will take it and will move it aggressively.
It's all very good leading up to it, but what now? What's happening with
Sure, no,
trade balance, US current account surplus, deficit? What's going to happen in your view?
Yeah. Sure. In my view, basically right now, we're going to be range bound for the next 3 months. And then throughout the next 12 months, we'll definitely breach the 2,000. Now, what is important to take into account is the level of panic in the market in general. If people start doubting more, then that can really take huge proportions. We're talking 3,000 an ounce. But if people don't get carried away, well, then I think we'll stay at that level. Personally, I think people get carried away. Right now, most of and this is my personal opinion, so I can't put EFG in it, but I think most of the rallies we see now are basically, I'm fed up of bad news rallies. People are just jumping on the last small thing. I mean, every day you take the newspaper, it's either super positive, we're out of it, or it's the end of the world. And I think that as we're going down, we keep on trending downwards. And if we have any external shock, it will move the gold price extremely aggressively, and that's when we come to up. My bet is on up very aggressively. But then again, I'm biased because I'm very enthusiastic about the metal itself.
But that's, quite a crucial point, isn't it? Isn't the gold price driven far more by psychological factors than by fundamentals?
It is, and that's why I don't like to predict, because I would have to be amongst the best psychologists in the world to predict what people were thinking. Because since you don't have an intrinsic value, and it is a good that is not interpreted the same way all over the world. I'll give you an example. You take Microsoft stock. Your analyst in Bombay will have pretty much the same opinion as in London as in New York. You take gold, it is culturally completely different in India or China as it is in the Western world. Very simply, the Western world, and I'm sorry to say this, is known for buying gold high and selling low, basically. Because they buy in panic, and as soon as it comes down, they say, oh, the trend is finished. Emerging markets, on the other hand, have been buying it for a very long period of time and are value investors. So they buy on dips. So you have these double relationships constantly, which makes it extremely difficult to predict, we're going to hit this target or hit that target.
So once the media stops writing about
then you
there'll be a huge correction probably.
Yeah, if the media stops writing about it, it will come under considerable strain unless you have, emerging markets that are accumulating it as they are now. Because China, for instance, that is all behind the media. UBS came out with a great research paper what was that, last year, that said the numbers that China came out with, what they were purchasing, was way above what they had expected.
But only in recent years, right? Or maybe
only in 2-3 years, yeah, because they were buying dollars.
In 1998, it was
exactly.
far higher than it's now.
Yeah, exactly. So they're buying in now because they're trying to move away, but they don't want to do it publicly. Now, gold transactions, official gold transactions, are anonymous, which is always not it's a good sign for the metal. It's a very bullish sign for the metal, but a lot is done behind the scenes.
You had a question. Oh, sorry, just a follow-up.
Why is China buying? Is it a T-bill hedge?
For me personally, my idea is they can't dump $1 trillion on the market, and they're trying to diversify. And they're probably going to use their dollars to purchase up US companies, as they've been doing with Australian companies and companies in Africa. But they need a new reserve. China has developed the Shanghai exchange. They're developing a lot of local exchanges. We've been personally speaking also with an exchange there that they're saying that they want to get the renminbi backed by it. I mean, there's a lot of things going on where they want to go back to a kind of gold standard. But again, gold standard is not really the answer. I mean, Jim Rogers said it very well when he said the term debasing came from the Romans, because when they had the gold coin, they said, well, if we put a little copper in, we're going to get more gold. And then within a few years' time, the coins were just copper and not any gold anymore. So it's not really the answer to all economic solutions, but there is the tendency there.
Okay, lady in the first row, you have a question. We'll pass your microphone.
What is your opinion about gold shares?
Okay, that's a good question. Gold shares are tricky to look at as long as if you're investing into them as a normal equity. When you're looking at a normal equity, you look at the valuation, you look at the PE. You cannot look at a PE of a mining stock, because mines, they have limited amount of time. So what you have to do is you've got to do a present value of what is the expected return. When you do that and you value your company that way, they're honestly right now quite cheap. The thing is where the cost for miners on average is around $700 to produce an ounce. That's the worldwide average. And what they're doing now is they're reinvesting anything above. They're extremely aggressive in reinvesting. The problem is whenever liquidity dries up, like in 2007, they're having trouble getting financing, etc. So you really have to look at different variables. So you need to know what the quality is of the geologist, their access to financing from banks, and how they're reinvesting their cash. And if you have a look at that, then you can really pick some good stocks.
Any other questions? One in the middle. Just here.
I'd like to try to understand this China level versus the rest of the world and how fast it's grown. Mm-hmm. First of all, production, China, it's a lot hidden, but are they producing more in their country than they ever have before, and is it just the beginning of a growth they can put on and show us all, in your opinion?
In my opinion, a lot of it is, I think it's hidden, and plus they're buying a lot abroad. When you're saying production in China is going up, as we saw in these figures, that includes
You use the word production.
Yeah, it's what they produce, yeah.
That's what I'm trying to establish as production.
Yeah. So it includes, a mine that they will buy in South Africa because it goes under the Chinese production. The thing is, they're extremely cash rich today, and they're investing aggressively, not only in gold, but if you look in Africa, for instance, over the past 15 years, who are the biggest investors in infrastructure? It's been the Chinese. And the funny thing is, unfortunately, a lot of people didn't ask themselves why they were there 15 years ago. Now they have a whole continent to feed them. Because what China needs is basically, they need energy, so gas and oil. For that, they got Russia and Iran. They need commodities to feed their population. For that, they built the infrastructure in Africa. And they need money. And for that, that's why they're accumulating so much gold, in my opinion.
Yeah, and they used to buy a lot of U.S. dollars, and now they're buying a lot of U.S. gold, so they feel, obviously, like the rest of the world, this has existed forever and ever, that gold is the bottom line.
Exactly, because they see that the dollars are not worth, well, I'm not saying, I don't want to put mouths in the mouths of the Chinese, but they see that they're limited with their dollars, but at the same time, they're trapped. They can't really sell it on the market, so they use those dollars to buy companies, right? And that's what we've seen. But it's all hush-hush behind closed doors, etc. That's why it's interesting when you speak with professionals of the miners or refiners, and you get to hear this. I mean, I thought when I used to work in the hedge fund industry, I thought hedge fund guys were dodgy, but when I started knowing more about the gold stuff, that's really dodgy. But it's all government-linked and everything. It's full of conspiracy theories. Very, very entertaining.
Okay, sadly, for the rest of this crowd, I happened to follow you for a long time, and when the recession hit, fortunately I was following you and we were out, and a lot of people got killed and creamed, and you were okay and I was okay. But what I look at today and how long it's going to go on and what's going to happen in our future, certainly what's going on in Europe, I'm sorry, I'm from Canada, but what's going on in Europe is very, very vital to the Europeans, and it's vital to all of us in the world. However, should a recession strike and hit, certainly gold has this feature. What I've always been troubled with, and I want to know if you have an opinion, is what Japan went through in the early 90s when the market got up to 32,000 or 35,000, whatever the number was, and it's sort of battled between the 10 and the 15,000 ever since. It's caused a lot of problem, and the market, they say, will never ever change. So what we have our markets now in North America and in Europe and so on and so forth. What is your opinion on the stock market, how it could be affected, where your feelings are as far as that goes, that particular field is?
Sure. My personal feeling on the markets, I think it's going to be very difficult for both Europe and the US to get out of their situation, because they're very similar to the situation of Japan, with more debt, because they're trapped. They've got no more interest rates to play with. It's very entertaining when you read on the press about the debt ceiling increasing next year. The article came out today, they said, oh, they'll have to make accounting adjustments. I don't even know what that means, accounting adjustment. You just change the accounting rules and then it's okay, I guess. So they are really, really trapped. So when you're trapped like that, you see those countries that have no cash, no commodities, they have a savoir-faire, and they've got a culture in it, but you have all the other countries that got the commodities, and they have the cash. Canada is a very good example. I studied in Montreal, and I remember when I was in Montreal, there was the huge issue with the taxes, and that Canada, indebted itself so much that they had to increase the taxes so high. What saved Canada was the rally on commodities. And that's really what got them out, where they're now a very stable country. And I think that's going to project on all commodity-denominated countries. I think we're really going to go back to basics. But that's a very non-financial thing, I think, to say, and that's my personal opinion.
Christian Wehbe, we have to leave it here.
Sure,
Thank you very much. No, it was very enlightening, very interesting.
Okay.
Thank you very much.
Thank you.
Christian Wehbe.